So historically, investors have sought to invest in emerging markets to seek higher returns. But as domestic private equity has performed incredibly recently, is it still worth it to venture into those emerging markets, given currency risk and longer holding periods and all the other risks associated with investing abroad, particularly less developed markets?
Well, there's a trade-off. Sam has a new book out, so he talks about emerging markets, that the risk trade-off for emerging markets, you're trading rule of law for growth. So in that scenario, you better make sure you know who your partner is. So we've allocated to emerging markets. My brother and his team are very active in those markets. So we have that connectivity in terms of network and trusted partners. So I think the idea that, and we had the stats up earlier, I think from Stuart's presentation, in terms of GDP, you can't ignore the emerging markets in terms of allocation, but you have to be careful.
It's been a frustrating time because you saw the numbers this morning just in terms of what the rest of the world and even the developing world represents in whichever way you want to slice it. So if you're just kind of investing like in an ACWI all-world index, China, I believe, is like 4%. And does anyone here, irrespective of some of those other things, only want to have 4% of their money in China? We decided a while ago, just to use that example, that we did, and we've built a portfolio in a variety of ways since that time. But it is very frustrating that speaking over since the crisis, I mean the best thing would have done that any of us could have done is just been a passive investor in a S&P 500 ETF. So but I think we're there for the longer term. But we definitely, when we're abroad, when we're in China, when we're in India, we're getting pitched why, the concept of premium shouldn't even be there anymore. But we don't agree with that. I mean, we're a small team. It's a lot of time, money, and effort to even do the diligence and be there frequently enough that you'd want to be if you are an investor in those geographies. So, we have the concept that we should be getting a premium, and I think that. Not everyone either on the LP side or the GP side agrees with that. That's fine, but we're expecting that for just some of the things that you highlighted, as well as a host of other things such as currency and whatnot.
Yeah, I've been doing a lot of explaining lately because we did a lot in emerging markets, and we have a fair amount of exposure. And to a certain extent, I have drunk the Kool-Aid, but I think what you have to realize, it's going to take 2 or 3 years longer, especially right now in emerging markets, to see I think there's value there. I think there's value in the companies that most of our managers have invested in. But when you just factor in, there's always going to be macro cycles in emerging markets. And I think you have to be prepared. Your committee has to be prepared when you go in to understand that that's going to happen. There's the currency headwinds. But at the end of the day, I think, you can invest with managers that can give you, you're not going to get, I think some people think, they're going to do twice the return they can get in the US. That's not actually going to happen. But I think you can get really, really good returns. And I also think if you're able to take a more regional or country-specific focus and partner with GPs that are really, I don't mean investing in the physical infrastructure of the country, but the sectoral infrastructure, whether it's telecom or whatever it might be, and take a more buy and build approach as opposed to just a global EM firm. I think you might be better placed longer term, but it takes longer.
Yeah, I think any institutional investor that's allocated to emerging markets has 1 or 2 horror stories to tell. Some trends that I'm seeing in my portfolio is emerging markets tend to develop similar to U.S. and other developed markets. So Equity International was formed because Sam thought that about real estate, that real estate would be institutionalized across the world. There would be REIT-like legislation, and that's turned out to be true. Other things that in the consumer space, we've got a manager in China that took the view that the Chinese are going to develop the consumerism exactly like the US. So he went first to non-discretionary, so a paper products company that makes toilet paper and feminine products. And then that was successful, and he pivoted with that same manager, and now they're offering discretionary consumer through wallpaper. So consumer space seems to work in Asia and Latin America, at least based on my experience.
I think, though, even when you're successful and you've picked the right managers and they've picked the right investments, there's a host of things out of your control. And one of the biggest things we're struggling with are exits, for example. And because there's been successful investments but not exits, it's kind of skewing sort of the portfolio composition of our total investable asset pool. So there's even issues that are sort of good things to have, but you're still having to spend a lot of time to deal with it.
Great. Let's open it up to the audience. Do any of you all have any questions you want to ask the panel? Sure. Down here in the front.
Hi, my name is Benjamin Levy. My question to you is, when is the last time you committed to a new fund in your portfolio, a new private equity fund, and how did you discover it?
Probably half of our commitments this year have been to first-time funds, but they've been spin-outs, experienced GPs that have come from other funds that have either the fund isn't going to raise another fund or they want to just start their own thing. So we spend a significant amount of time doing that, and we're comfortable kind of being an anchor investor in those. And we prefer actually when we're doing something like that to be more of like a club deal where there's a handful of investors supporting a new manager.
My recent allocations were follow-on funds to existing managers, but I'm looking at a new fund manager in domestic industrial space, telecom space, and then consumer space.
I assume you meant a new fund manager as opposed to a new fund for our organization, or both. Yeah. I mean, I think for us, we're much more comfortable if it could be a new fund manager, but not a new person. So in many cases, it's someone that's been with a larger organization or an organization, a GP that we've invested with for a while, and for whatever reason they saw an opportunity and they've left to kind of create their own organization, and that's just a much easier process for us than someone that is new to us, which takes a lot of time to sort of get over, even if they're on their third or fourth fund. But to be new to us and to be sort of new to having their own fund, it's sort of a double hurdle to get over.
Great. Right there.
I've observed that some buyout funds have moved from using their line of credit to bridge small timing gaps between when they need to fund their purchase of a company and when they can receive the capital call from their LPs, to potentially using the full line of credit up to 20-25% of committed capital, perhaps having it outstanding for a year or more. I've thought about this issue, a good deal, and my two biggest concerns are, one, a situation similar to 2008, where perhaps the fund is heavily deployed but hasn't called its commitments, and perhaps LPs, having second thoughts when the capital call does come, if the portfolio has been written down significantly. More than that, I'm just concerned that performance measurement's going to be skewed or obscured in the short term and medium term. Just wondering how you all feel about this issue.
It's a huge issue, and it's just becoming bigger and bigger. Last 2 weeks ago in Boston was the ILPA member conference, and that was a session on its own. It's become more prevalent, and it's not really LP versus GP, because many LPs are actually comped on an IRR measure, and this is an IRR enhancer. Certainly the GPs have their carry kick in on an IRR measurement as opposed to multiple measurement. where we've kind of drawn the line is to basically push back on anything that's more than 180 days, preferably less. And there's just a whole host of issues that come into play. The other thing that we're doing where we have influence with the fund is we're insisting that numbers get reported now on performance numbers, if not quarterly, because that's less meaningful, but at least every half a year, both showing IRR as if the line wasn't there and with the line there, and then you could kind of see the delta between the two. And if it's meaningful, then I think it's less about the alpha that the GP has added, and it also is going to keep them a little more honest, we figure, because they're having to put it into black and white. So I think if all of you that are LPs kind of start insisting on that, there's nothing wrong with it, but you've identified just two of the issues. I think the Oak Tree letter last month from Howard Marks kind of went into a lot of things that, quite honestly, everyone's been talking about in different places and kind of put it into one nice memo. It's a nice thing to look at, but it also may just be a sign of the times, because interest rates are cheap and interest rates are low, and when they're higher, it's going to be less prevalent.
I think it ties in a little bit to the comment earlier about longer duration. I think GPs are responding to the carry incentive, which is based on a pref that typically deploys. That pref kicks in when you call the capital. So if you can delay calling the capital, you're delaying your pref. And just like at the tail end of a fund, you see GPs holding on to assets where I think the LP base would like them to wind down the fund, but the incentive structure is for the GP to hold those assets because they're collecting 20 cents on every dollar that comes out. So, I think there's some structural things that probably need to be tweaked, and one is disclosure, for sure.
Great. I think we have to end it here. So we are going to...
One more.
Okay.
Thank you. Thank you very much.
Yeah.
One quick question. With pricing getting to be very high on buyouts, last couple of years, if you're paying 10, 12 times EBITDA on multiples, have you all changed your investment pace and making new commitments to new funds, or have you changed what you're choosing to invest in, whether it's sector or size of fund, or any other changes you've made, and what those changes are?
We get a fixed allocation, so we tend to commit the same amount roughly every year. So we're not committing at a different pace. I think we've always been, though, again, we're not in the large buyouts. We've been in the smaller funds, and we tend to do a lot of buy and builds. So on average, if you look at our managers, today they're paying somewhere 7, 8, 9 maybe times, but then their add-ons are getting done like at 5 times. So the blended all-in sort of comes down. So that's kind of how we think about it.
I think one thing we've seen over time is that private equity funds that are raised sort of at this point in the cycle, so definitely current prices are very high, and they've been high for a period of time. We're sort of at the tail end of, or we expect to be at the tail end of this sort of bull run. But private equity funds that are raised today and deploy into what maybe is maybe a declining valuation environment, and then hopefully selling into that recovery. Sort of counterintuitively, funds that are raised today end up outperforming funds that were raised 3 or 4 years ago and have been deploying into this really high valuation market. So I think, in some ways, to Dale's point, the motivation should be to try and invest consistently with good managers where the alignment's, good.
Yeah, I think we want an experienced manager, especially at this point in the cycle, that can show that they had dry powder 10 years ago and didn't go crazy deploying it because of their discipline. But it's very hard to sort of time our commitment to getting money in the ground when the opportunity is on the other side. So we're not necessarily trying to do fewer commitments in 17 than in 15, but we're hoping that the managers behind the funds may deploy money in a very asymmetric fashion based on the opportunity set.